So I get asked all the time which life insurance is best, term, IUL, or whole life. And here's the thing nobody tells you. The answer isn't which one is best, it's which one fits what you're actually trying to do. Most people think term is the cheap option. IUL sounds like free market growth without the risk, and whole life just sounds boring and slow. But the industry leaves out critical details on all three of these. By the end of this video, you'll know exactly which one fits your goals and why the common wisdom you hear from most financial gurus is incomplete. Here's why this matters. Choosing wrong locks you into decades of missed opportunity or unnecessary fees. So let's break down all three and I'll show you which one I prefer and why. All right, so let's start with term life because this is what everybody preaches. You've probably heard it 1,000 times. Buy term, invest the difference. It sounds logical on paper. You pay lower premiums for pure death benefit coverage. You take your money that you would have spent on a permanent policy and you invest it in the stock market or index funds. Over time, you build wealth separately from your insurance. It makes sense, right? Here's the problem. Your insurance has zero cash value and it's pure protection, and your investments are locked in market risk. So what happens when you need capital for an opportunity, but your stocks are down 30%? You're stuck. You can't access the insurance money because there isn't any. And if you pull from your investments, you're locking in losses. That's the liquidity problem no one talks about. But here's the bigger issue. This whole strategy assumes you'll actually invest the difference consistently, and the reality is most people don't. They spend it. They upgrade their car, they go on vacation. They convince themselves they'll start investing next month, and the next month never comes. So you end up with cheap term coverage and no wealth building happening at all. Now, let's talk about what happens when your term policy expires. Most term policies run 10, 20, maybe 30 years, and after that, you're done. And here's the kicker. You're older now, maybe you've got health issues, and if you try and get a new policy, you're either paying insane premiums or you're uninsurable. So you've paid into this thing for decades and you're left with nothing. No cash value, no coverage, no liquidity. Now, don't get me wrong, term works for pure protection. If you're on a tight budget and you've got dependencies that need coverage if something happens to you, term makes sense. It's cheap, it's simple, it does the job. But it's not a wealth tool. It's not designed to give you capital. It's not designed to build anything. It's just insurance. So the buy term and invest the difference philosophy works if you're disciplined, if you actually invest the difference, and if you don't need liquidity from insurance. But for most people, that's not a reality. That's why I don't rely on term as the only strategy. It's a piece of the puzzle, it's not the whole picture. The other thing people miss is when you're investing the difference, you're still subject to market timing. If you retire in a down market, your portfolio takes a hit. If you need money during a recession, you're pulling from depressed assets. With term, you've got no backup plan. There's no cash value to borrow against. There's no liquidity buffer. You're just hoping the market cooperates when you need it to. And hope isn't a strategy. So term is great for what it is, cheap temporary protection. But if you're thinking building long-term wealth, you want access to capital along the way. Term leaves you with nothing. All right, so now let's talk about indexed universal life. This is the one that gets pitched as the perfect compromise. You get market upside without the downside, and it sounds amazing. Your cash value is tied to an index like the S&P 500. You've got a cap on the upside and you've got a floor on the downside. So if the market goes up 15%, you might get capped at 10 or 12, but if the market drops 30%, you get zero. You don't lose money. That's the pitch. But here's what they don't explain: the fee structure. IULs have costs of insurance charges, administration fees, rider charges, and all these fees compound over time. So yeah, you might see growth in your cash value, but a huge chunk of it is getting eaten up by fees. And the longer you hold the policy, the more those fees compound. By year 20, your fees have compounded massively and they're eating into the returns they sold you on. Let me show you the gap between illustration and reality. When agents sell IUL, they show you illustrations with 7 or 8% average returns, which look great on paper. but actual performance is often 3 to 4% after fees. That's a massive difference. You're thinking you're getting stock market like returns with downside protection, but in reality, you're getting savings accounts returns with insurance costs attached. Now, let's talk about the cap problem. In strong market years, you're capped at 10, 12%, while the actual market is doing 20% or more. So you're missing out on the big gains. And in down years, yeah, you get a zero floor, but you're also not participating in the recovery the same way. You're sitting in the sidelines while the market rebounds. So over time, you're underperforming compared to investing directly in the market. And here's the other thing, IULs get pitched as a long term strategy. They tell you to hold it for 30 years and let it grow. But what they're not telling you is that the internal cost increases as you age. Your cost of insurance goes up every year because you're getting older, and the insurance company is taking on more risk. So the older you get, the more expensive it becomes to keep the policy in force. And if you're not careful, these rising costs can eat at your cash value to the point where the policy implodes. Now, does that mean the IUL is a scam? No, it's not a scam, but it's not the best of both worlds that they claim. It works in very specific situations. If you're maxing out all other tax advantage accounts, your 401k, IRA, HSA, and need more tax deferred growth, an IUL could work, but you need to get into knowing the fees, knowing the caps, and knowing that your actual returns are going to be lower than the illustration. The problem is most people don't know this when they buy it. They see the illustration, they hear the pitch of market upside with no downside, and they think they found the holy grail. But 10 years later, they're losing their cash value and wondering why it's not growing when they thought it would. And the answer is fees. The fees are the silent killer in the IUL. So if you're considering it, make sure you're asking for the fee schedule and the actual historical performance, not just the illustration. All right, so now let's talk about whole life. This is the one everyone loves to hate. And the biggest criticism you'll hear is whole life grows slower than investing in the market. And that's true. You're typically earning 4 to 6% in dividends, not 10% or more like you'd expect from stocks. So on the surface, it looks like you're leaving money on the table. But here's what most people miss. The advantage isn't in the growth rate. Its advantage is in immediate access to cash value through policy loans. And this is the most underrated wealth tool out there. Let me explain why this matters. Let's say you're an entrepreneur and you need $30,000 for a business opportunity. Maybe it's inventory for a product launch. Maybe it's a down payment on a rental property. Maybe it's just capital to scale. If your money's tied up in stocks or a 401k, you've got a problem. You either sell and lock in whatever the market's doing that day, or you miss the opportunity. But you've got a whole life policy with cash value you can use to access the money in 48 hours. No credit checks, no approval process, no waiting. You borrow against your policy and you've got the capital. And here's the thing, this isn't about replacing your stock portfolio. This is about having a reservoir of capital you control. The concept here is liquidity. Most people focus on returns, they ignore liquidity, but liquidity is what gives you options. It's what lets you move fast when opportunities show up. And opportunities don't wait for your stocks to recover or your 401k to vest. Here's how the Rockefellers use this. They didn't choose between whole life and investing. They kept using both. They kept their whole life policies as a liquidity buffer, and they invested in business and real estate on top of that. The policy wasn't the wealth builder, the policy was the bank. It was a place they could pull capital without disrupting their other investments. And this is where policy design matters. Most people think all whole life policies are the same, but they're not. A policy structured with high cash value, low death benefit changes the game. You're not buying this for the death benefit, you're buying it for the cash value and your ability to borrow against it. So when you design it right by maximizing the amount of money that goes into cash value from day one, instead of paying for a huge death benefit you don't need. So here's the strategy. You borrow against your policy, you invest the money elsewhere, real estate, businesses, whatever, and then you repay yourself. Your policy keeps growing because the insurance company doesn't care if you borrowed against it. Your cash value is still earning dividends and you're using the same dollar twice. That's the banking strategy. And that's why I prefer whole life mixing with traditional investing. The downside of whole life is simple. It doesn't grow as fast as the market. You're earning dividends, not stock returns. But the trade off is liquidity and control. You're not waiting for the market to cooperate. You're not subject to timing risk. You've got a stable, predictable asset that you can access whenever you need it. And for me, that's worth the lower growth rate because wealth just isn't about how much you make, it's about how much you control. So, how do you actually choose between the three? Here's the framework I use. Start with your primary goal. Are you looking for pure protection, tax deferred growth, or liquidity? That's the question that determines everything. If you're on a tight budget and you've got dependents who need coverage, term makes sense for now. It's cheap, it's simple, and it does the job. You're not trying to build wealth with it, you're just making sure your family is covered if something happens to you. That's it. Term works perfectly for that scenario. If you're maxing out your retirement accounts, your 401k, your Roth IRA, and your HSA, and you want more tax advantage growth, an IUL could work. But you need to know the fees. You need to ask your agent for the actual fee schedule, not just the illustration. You need to understand that your returns are going to be lower than what they're showing on the paper. And you need to be okay with that. If you go into it with eyes open, the IUL can be a functional piece in your strategy, but don't expect it to replace your stock portfolio. If you want a liquidity buffer and you want to control your capital, whole life is the move. This is what I use. This is what I recommend to people who are thinking long term and who understand that liquidity is more valuable than chasing your highest returns. You're not just using the strategy to replace investing, you're using it as a bank. You're building a reservoir of capital that you can access whenever you need it without disrupting your other investments. Now, here's the thing. You don't have to pick just one. The hybrid approach is what most people should be doing. Use term to cover if you need it, use whole life for banking, and then use your taxable accounts for growth. Stop thinking which one is best and start thinking which one fits my strategy because the answer isn't the same for everyone. The key transformation here is understanding what each tool is designed to do. Term is protection, IUL is tax preferred growth with fees, and whole life is liquidity and control. Once you understand that, the decision becomes easier and you're not comparing apples to apples. You're comparing tools that do completely different things. And if you want to learn how to structure a whole life policy for maximum cash value and how to design it so you're building liquidity from day one, I'll show you exactly how you set it up so you're using it as your banking tool instead of just insurance. That's where the real power is.